Hey guys, Whitney here. Welcome. It's Tuesday. I'm so excited. We've got another masterclass ready to start here. I'm going to give it just a couple minutes for people to file in the room. For those of you who've never joined our live Tuesday session before, this is an interactive session. We are going to be recording it and publishing it as a podcast. And this is your opportunity to ask questions live. So I want you to go over to your Zoom chat bar and find the Q&A box and ask your questions there. That'll actually help me stay really organized and make sure that we get through everybody's questions by the end. Anyways, you can ask them in the chat. I'm going to be looking in the Q&A box and answering all of the questions there first. I'm going to try to answer as many as I can during the course of the presentation. If not, we are going to hang out after the recording and, we can kind of like open it up to an ask me anything type session. So anyway, guys, I'm going to go ahead and get us started here. And first of all, this is the Passive Investing Made Simple show. Guys, I am Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And I do this weekly show for you so you can learn all about the different aspects of passive investing, as well as the terms, the pros and cons, and even math. And guys, we're going to go into a little bit of math today, so get your thinking caps on. Sometimes I bring on a live guest, and sometimes we do a solo show, so I can actually kind of be your mentor, your guide, and just give you insights about my experience around passive investing. So welcome to today. We are going to tackle the topic, how to retire in 5 years with passive real estate. I have the opportunity to speak to many investors, hundreds and hundreds, probably a couple thousand at this point of investors. And they really always ask me the same things, like, regarding passive investing, but really, how can I build my plan? Now, we are not financial advisors here. So what I want to do is arm you with 4 principles of investing that can help you hedge investing risk, okay, as we think through how are we going to retire with these assets. I'm also going to help you understand 3 rules of passive investing that an investor has to abide by right now in order to make profit in this type of economic environment. And also help you to put these principles and actions into use so you can collapse time and stop necessarily chasing yield. Now, guys, it's not to say that we aren't looking for a return from our assets, but really so you can invest in safe, conservative assets and know that you are going to be hitting the plan year over year over year. All right, so if you guys don't know me, again, my name is Whitney. This is the whole reason why I personally invest in passive real estate, is to spend time and travel the world with my crazy crew here. I actually started off as an accidental investor in 2002, living, flipping, and house hacking. Now, those terms weren't necessarily coined back then, not that it was anything new, but I had bought a house with a significant other, and the relationship quickly fell apart. And here I was with a house, and I thought it was financially going to ruin me. And so I was thinking through all the different ways that I could actually get out from underneath this house. And so I was young. I shoved it fully roommates. I was doing a lot of traveling for work, so I wasn't there all the time. So I had roommates living, in every room in the house, even my room whenever I wasn't there. And then they didn't mind living in a construction zone. And so over the course of the next 11 months, I rehabbed the house. YouTube did not exist at this point in time. So I was actually utilizing the Home Depot 1-2-3 book and probably doing a lot of things that I shouldn't be doing myself, like drywall. Long story short, 11 months later, I sold the house for a profit and realized I hadn't been paying for any of my expenses the entire time, not the mortgage, not utilities. And I was like, oh man, how many more of these type of projects can I do? So I did several more flipping projects, on my own and with my husband, who's pictured here. And then, fast forward a few years later, we really couldn't understand how to unlock our golden handcuffs. We're like, this is great. We can build up tons of equity, but how do we actually retire? We wanted to step away, or at least have the option to step away, the freedom. I talk a lot about the 5 freedoms that passive real estate can give you: financial freedom, freedom of choice, freedom of time, freedom of location, independence. Okay, those are just a few of those there, and freedom of impact. But we weren't able to do that. We started scaling our investments, putting renters in the properties, scaling our investments that way. But really, all we felt like we had was another job. And it wasn't until we hit another ceiling of achievement and we decided, like, we need to figure out how to take a lot of our equity that we're accruing in our active properties and have it work for us simultaneously in building wealth. That is when we discovered passive real estate, and we really blew the doors off of our portfolio. So to date, we have over 6,300 multifamily units and 1,400 self-storage units. And you can add, mobile home parks. You can add a few other modalities in there as well. We have, we're invested in car washes, real estate debt as well. The long story short, these are just numbers, but what most people are after is the result. And our results is that we actually have 100% freedom of choice on how we spend our time. Now, guys, I'm spending my time here with you. I love doing this. I love talking about all things real estate, as well as the impact that investing in real estate, especially passive real estate, has had on our lives. But we still add value. We still work. We're not going to be the ones laying on the beach drinking Mai Tais or margaritas. And we can actually help you at Passive Investing do this as well. We have acquired over $1 billion in assets, multifamily, self-storage, hotel, car washes. We have over 1,700 passive investors in those assets. And I would love to have the opportunity to talk to you guys about it. If you're interested, I'll show you how to do that at the end of the episode. But right now, let's start diving into the math, because you guys aren't here for me, you're here for you. Now, before we start diving into today's topic, what I'm going to share with you today is not financial advice. Okay, feel free to take a screenshot of what I laid out, what I lay out for you, but it's not financial advice, nor legal advice or tax advice. So you need to talk to your team, your professional team of accountants, financial advisors, and lawyers before making any sort of investment decision. Okay, you really need to own the decision yourself and make sure this is the right one for you. But I'm going to show you how you can do this. And, I'll actually point out where I am in my wealth building portfolio so you can see visually how this works. Now, before I dive into the math, right? I know everybody's like, show me the math. Like, how does this really work? I kind of share with you the basic principles that you have to follow. Now, you guys, the title of the show is Passive Investing Made Simple. Okay, there are a lot of different things that you can do in today's environment, a lot of shiny objects to chase, but really we need to make sure that our assets in our portfolio are doing 4 core things. And if they do these 4 core things over and over and over, it is extremely difficult to lose money. Now I'm going to point out 4 core things and pillars, as I call them. And there's 3 rules on top of that we need to layer on. So let's dive in. Okay, first, why would we even base our investing on principle here? I don't know if you guys have read the book Principles by Ray Dalio. He has far more than 4 principles for his investing in his life in there. But I'm going to show you just 4 core ones that if you can just essentially create a grid for yourself and evaluate all your assets on, it's really going to kind of enlighten you of how you're investing and what the potential return is really truly happening in your portfolio. That having rules in your investing actually will help you make sound investments according to your goals and needs, not so much chasing yield. A lot of investors are disconnected. Everybody wants to make a higher return, but many times that return comes at a much higher risk profile. And that risk profile could be actually adverse to what you need in your portfolio for your actual financial goals and where you are in your journey. It can also, investing by rules, having a set kind of way methodology on how you're looking at your investments can keep you from making very rash decisions. Okay, again, goes back to that shiny object syndrome. It'll keep you kind of grounded. And whenever these, I know most recently somebody put a SpaceX investment in front of me, and I'm like, this is amazing. I have an opportunity to invest in SpaceX. However, when I compared that investment to my core investing principles, I was like, this is speculative. Okay. Now, it doesn't mean that I can't invest in a speculative investment, but is it going to help me reach my goals? Maybe, maybe not. Am I willing to take that risk? So again, keep me grounded and making from a rash decision. Okay. Again, the principles I'm going to show you is going to help you open your eyes to all the different ways that you can make money in real estate. Okay, it's not always about one way we make money. It can be multiple ways. And then also hedge against risk. Okay, we're in a volatile environment. Okay, I don't see any way that you can't like look at the news, look at a newspaper, or see the headlines on Google or whatever, and not have some sort of like doomsday headline put in front of you. Okay, the risk and the volatility is real. However, investing by principle can actually help you hedge this environment, especially if you're paying attention to all 4 principles, as well as abiding by the rules that I'm going to lay out for you. Okay, so what are these principles for building wealth? Okay, this is going to seem really simplified, but that's the whole point. I want to strip it down into just some real simplicity for you, because complexity is the enemy of execution. Okay, and that's how I live my life. If it's too complex, the chances of me executing 100% every single time is going to be very difficult. So for me, in my portfolio, and I sit down with my portfolio, all of my investments. Okay, I'm in over 50 passive investments, and that does not include my active holdings that I have, like my personal long-term rentals, short-term rentals, and stuff like that. But I evaluate all my assets every single year, okay, according to these principles and these rules. Okay, number 1, capital preservation. Number 2, cash flow. Number 3, equity, growth, and levers. Number 4, tax benefits. Don't worry, guys. I'm going to dive in on each of these topics. So capital preservation. Most of you guys know who this is. This is Warren Buffett, Berkshire Hathaway. Okay, he has 2 top rules. Now he has many rules to investing, but his 2 top rules to investing: never lose money. Rule number 2, see rule number 1. That's how important it is. So we need to make sure we're looking at assets that are going to preserve our capital. So we're looking for assets that are secured by a hard asset, an investment secured by a hard asset. This is where the stock market, paper assets are failing us right now. Cash is failing us right now. Cryptocurrency arguably might be failing us right now. Okay, there's not a hard asset behind these things. Gold, okay, gold is present. It's a hard asset, but it doesn't beat inflation. It merely tracks inflation. Okay, so it's doing its job. If you converted cash into gold, it's doing its job. It's keeping within 2 to 5 percentage points of where we are with inflation. Think about it. If you had $20, like in the 20s, you could buy 1 ounce of gold. Then you could go buy, a friend of mine always points out the illustration. You can go buy a suit, tie, and shoes. Okay, that same gold today would actually probably exchange for just under $2,000. That still gets you a suit, tie, shirt, and a nice pair of shoes and a belt, right? You can still clothe yourself, right? It's just holding its value in the market. All right. We also want to look for assets that are valued on net operating income or expected gross income. All right, thanks for, somebody dropped into the Q&A, exact spot price of gold, 1806, okay? So there you go. It's holding its value right now. All right, number 2, valuation based on net operating income or expected gross income, okay? So when we invest in assets that have that type of valuation, we're gonna be able to control the asset's value and impact it as an investor. I'm going to explain this more in the equity section. We also want to make sure, okay, and like any asset, whether it's your own personal asset in your portfolio or you're investing in a passive asset, you want to make sure there's adequate reserves to maintain that asset through all the ups and downs and the bumps and the rides. Okay, we do this with any asset that we're acquiring. We carry hefty reserves, CapEx and operational reserves. You want to be able to stay in the game and not have to sell in a down market. Okay, that is the reason why you want these reserves. All right, principle number 2, cash flow. Again, I put up a picture here of an apple tree. Okay, this picture alone demonstrates what I mean by investing with cash flow. It's not necessarily that you have an asset that's going to eventually give you cash flow, okay, or could give you a one-time large payout that you might consider cash flow, is that you're in an asset that you can pick regularly, apples off the tree and consume the cash flow. Okay, it's renewable. It will come back. That cash flow will come back in week over week, month over month, or season over season. Okay, so I like looking at assets that have multiple units of cash flow, and ideally that cash flow from day one. Okay, so this can be like, this is why I love multifamily buildings. This is why I love car washes, self-storage, hotels. This is why I love these type of assets. It's also why I'm staying away from developmental assets. This is just me personally. I don't have the risk tolerance in my portfolio to carry a development asset. Cash flow too, we want to be able to have a plan to increase it over time. Okay, we're going to talk about those net operating income levers here in a second. We want to have a low break even number. Okay, an asset might cash flow right now, but if we have multiple units of cash flow and then all of a sudden our occupancy drops down 10, 15, or historic lows 40%, does the asset still cash flow? Can it still pay the bills? We want it to be able to take a historic hit and still cash flow. This is one of my hangups. I have long-term rentals in my portfolio. I have single-family rentals in my portfolio. And this is one of my hangups here with the long-term rental, single-family assets, is that you can't take that hit. It's not like you're either making money or not. You're either making money or you're losing money. Okay. And again, like cash flow, you want to be able to have those reserves to maintain the asset. All right, equity levers. Okay, we want assets fundamentally in our portfolio that can take advantage of the market, take advantage of forced appreciation, and take advantage of outsourcing the debt and potentially tenant pay down. Now, when we look for assets that take advantage of market appreciation, we want to be, doesn't matter what the asset is, it can be self-storage, it can be multifamily. We want to be in a growth market. Okay, we want to be, we want to go where the fundamentals are in our favor. Population's growing, income's growing, jobs are diversified, especially if we've got like a tenant in there. We want to make sure that the area has low crime, low poverty, is pro-business, both in taxes as well as if we're working with the tenant or not. We also, once we determine those large areas, we want to look at the sub area where that actual asset resides. Is it in the path of progress? Guys, if you joined us for our presentation on Charlotte a few weeks ago on the market report for Charlotte, Eric Fitzgerald, our director of acquisitions, very clearly laid out, you want to be on this side of Charlotte, not this side of Charlotte. Okay. Now, a lot of people are investing in Charlotte, and I know many investors that are on the wrong side of that path of progress. Okay. We want to also be in markets that have room to grow, that aren't topped out. You don't necessarily want to be especially if you're buying like a high price asset, you don't want to be the top dog in the market. Now, here's where the rubber really meets the road: forced appreciation. Okay. A lot of people, especially coming from short, long-term rentals, single-family rentals, they're all about the BRRRR. How can we rehab it and push value? Well, there's multiple ways that we can do that. And it doesn't always have to be a rehab. But step number one, can we increase the actual market rent of the unit, and does it require a rehab to do so? Okay, how can we increase the income on the property? How can we decrease the expenses on the property? Right? Maybe we can renegotiate vendor contracts. Maybe we can, negotiate like our debt expenses down. How can we actually increase that delta of net operating income between raising our income and lowering our expenses? And then how can we add additional streams of income to the property? All right. Again, all of this feeds into that net operating income equation. And we're investing in commercial assets. Okay. Net operating income, expected gross income, say like in our car wash deals, that is how the asset is evaluated. It's not based on comparable sale. So if you guys have any questions about that, because this is super important, for investors to understand, especially when you're evaluating assets that go into your portfolio that are going to help you retire, we want to, remove as much of that comparable asset risk as we possibly can. Okay, you can make a lot of money there, but it can be a little bit risky. All right, and then number three, how can we outsource the debt? Okay, and maybe even get the tenant to pay it down. All right, Last principle here, tax benefits. Okay, we can spend each one of these areas, principles, we can spend a whole hour talking about. I'm just kind of giving you a 30,000 foot view on the tax benefits. How can you be in assets that take advantage of depreciation, take advantage of cost segregation analysis to accelerate depreciation to the early years of the project? How can you take advantage of bonus depreciation? Okay, right now, this year is the last year for 100% bonus depreciation. It's not that it goes away, it will start ticking down over time. And, maybe we'll have, a different tax package, tax laws, and, it'll look different here in the future. Okay, but right now, we're over the next 4 years, we're seeing bonus depreciation sunset for us. How can we take advantage of the 1031 exchange? Okay, this is what the IRS incentivizes us as investors to solve problems like housing problems, like real estate problems, so they don't have to get involved. They become our partner. Okay, now it doesn't eliminate your taxes. We're kicking the tax can down the road, but potentially if you die with the asset in your possession, and then it can, it will be able to pass on right now currently to your heirs, tax-free. There's some other, tax planning things that you need to talk to your CPA about in order to be able to 100% pass it on tax-free. But that is a very powerful way to eliminate your tax bill on some of these assets. All right, now I told you there's four basic principles that we need to follow. What I encourage you is to create a spreadsheet of all your assets in column 1, and then put those 4 principles across the top. All right, and evaluate each one of your assets. Okay, does it actually have that principle or not? All right, because then you're going to now begin to understand just how stable that asset is going to be for you long-term in your portfolio, and how it's going to be able to impact your wealth, okay, over time. Now, there's 3 additional rules to layer on top of this. Okay, so we can now create 7 columns. We can add each one of these rules to the other columns, but especially right now in this environment, we need to be able to be in assets that are going to pass inflationary costs on to the customer. All right, so that is how investors are going to be able to hedge risk right now in this inflationary environment. Does the asset, rule number 2, does the asset arbitrage debt wisely? Okay, this is not the time to take really risky loans with your asset. Okay, I have several investors that I work with personally that are in 3-6 month construction loans, and they got to refinance out here in 3 or 6 months. I don't know if you guys were watching the rate market yesterday. There was a lot of issues that happened there. And guys, I see a couple of hands raised. If you got a question, go over to the Q&A box and make sure to dump in your question. That'll help me keep track of all your questions. Okay, so add in that column. Does that asset actually arbitrage the interest rate environment safely? Are you locking in debt for at least the duration of the project and opportunities to cap or extend that rate should you need to hold on to the asset a little bit further? All right, and then number 3, especially if you're investing passively, you have to invest with an expert team that has a track record for performance. Okay, that's very important right now. We talk a lot about this at passiveinvesting.com. Dan Hanford has talked a lot about it. His 7 red flags for passive investors, or actually 7 red flags of investing that passive investors should pay attention to. But it is very important in this environment that you are making sure that you're with expert team that can hedge and perform in this environment. Okay, we've covered the principles, and I wanted to make sure that we went through the principles before we actually dived into the math, because the math actually is incredibly simple. Okay, now simplicity does not mean easy to execute. Okay, let's not confuse that. Okay, but I didn't want to put up some simple math here and in 5 minutes go, thank you guys, we're done with today's lesson, because it's really more complicated than that. The math actually is predicated that we're investing in assets that actually perform to all four of those core pillars that I showed you, those 4 pillars of investing, and are able to pass through cost of inflation to the end customer, that are able to arbitrage interest rates safely and effectively, and especially if you're investing passively, that are with an expert operations team for performance, okay? Because the operator, when you invest passively, is the deal. Got to bet on the jockey, not the horse. All right, so let's take a look at the math. All right, so you got to be able to kickstart your plan. All right, so, and I'm going to explain to you how I was able to kickstart my plan. All right, now the assumptions in the math here is that we're looking for assets that have a modest preferred return of 7%. Now, I always will look for assets that have a preferred return, because that tells me that I'm aligned with the operator, that they are confident in their performance and their numbers, and that, you know, I get the first 7% of that deal. Okay, it is not a guaranteed return. It is a preferred return. Okay, so it still means that the asset has to perform. And I'm looking for assets that give me a 2x equity multiple in about 5 years. Okay, I realize I didn't put the time span on that, but a 2x multiple in about 5 years. That's what I'm looking for. All right, so year number 1, how can you invest a large chunk of money? Now, for here in this particular illustration, I said that the investor invested $350,000 in year 1. Now, for some people that are like, got that in my bank account, or I can roll over my SDIRA and I can kickstart my plan. Other people might go, how do I get that done? Like, how can I access that chunk of money? Do you, HELOCs, potentially as a way to, aggregate large amounts of money. Like if you've got equity stuck in other assets. For us, we had our rental portfolio that was kicking off income, and we had equity that we could liquidate out of that. So if you have $350,000 invested at 7%, that's giving you $24,500 in income in year 1. Okay. You know, who doesn't like an additional bump? But is that going to, get you to retirement? Certainly not. And then from there, we're looking for that investor to invest an additional $100,000 year of new capital. Okay, not reinvested dollars, but of new capital year over year. It can come from their job. It can come from other equity sources within their portfolio, converting active assets into passive assets, but we're looking for $100,000 minimum of new capital coming into the portfolio. So in year 2, we can bump up our income to $31,500. In year 3 to $38,500, year 4 to $45,500, in year 5, $52,500. Now, the question that I'm sure that you guys have in your head is just like, $52,500, I probably can't retire off of that. Agreed. This is where the magic actually happens. Okay. In year 5, okay, or into year 6, that first investment is going to liquidate, okay, or reposition or 1031. Now, I don't know about you. For me, I wouldn't be sitting on that cash that asset's been kicking off for 5 years. I would have reinvested it. So these numbers are actually an under projection, but let's pretend that I was sitting on that and I didn't reinvest the capital. So I'm going to take that capital, okay, all that cash that I've been setting aside, I'm not consuming it. And that asset, I'm going to combine it with my gains. Remember that after 5 years, that at my initial $350,000 now becomes $700,000 between the gain on the sale and my capital, or the distributions that it's been kicking off for 5 years. Now I'm going to reinvest all of that. And then again, an asset with a 7% preferred return, about a 2x equity multiple. And I'm now going to have $77,000 of income coming in between that initial $350,000 that's doubled and the other $400,000 investments that were kicking off $28,000. Okay. Year number 7, that second asset's going to disposition. Again, it's doubled, 2x equity multiple. So between my gain and all that cash that's been sitting there, I'm now going to be able to, instead of it earning $7,000 a year, it'll be $14,000 a year. Now I still have my other 3 assets, okay, that were kicking off $7,000 a year. But now my cash flow is bumped up to $112,000 a year. Now notice here in year 6 and year 7, I didn't add any new money. All I'm doing is now reinvesting what these assets were kicking off. Okay, year 8, I'm going to allow investment number 3 to do the same thing, to double on me. I'm going to combine that all together. My cash flow bumps up to 140. Year 9, asset number 4 does the same thing. My cash flow bumps up to $161,000. In year 10, it's reinvested. My 4th asset or 5th asset now has doubled, and it's bumped up, my cash flow to $175,000. Okay, guys. Now you said, but wait a second, when you're now at 10 years of a timeline, but you said, how do I retire in 5 years or less? Guys, remember, all I did is I kickstarted my plan within 5 years. And now I get to choose when, at any point in time, when do I start harvesting this cash flow? When do I want to start living off of this? Okay. And now I can maintain it and move it forward. So again, this is, the magic of investing in real estate. I encourage people not to live off their income, especially if you're in the accumulation phase of your retirement build, reinvest as much as you can back into your business. And if you guys are joining me live, you see me doing air quotes around your business, but that's what it is. You're reinvesting back into your real estate business in order to grow it. Okay, guys, I've done a lot of talking. I'm sure you have a lot of questions. If you guys are joining here live, our after party is about to start. If you are joining us after the fact on what your podcast of choice, you can reach out to me at passiveinvestingwithwhitney.com. There, I've got some free goodies for you. You can also schedule time with me, and I'd love to walk you through what your real estate goals are and how we can help you achieve them. Until next time, guys, thank you so much.